Okay, so we're going to get started in just a minute. I certainly want to thank everybody for coming, and happy Tuesday to everybody. And it's always interesting to see where everybody is coming from. If you want to put that in the chat as to where you're coming in from, that's always fun to see. And I'm Deborah McConkey, and I'm the chair of programming for HBSWA. I'm currently in Boston because I'll be attending my reunion this weekend, and then I'll be back in San Francisco. So if any of you want to put your names in the chat. So before we get started, we have several great events coming up. For those of you who aren't members yet, I hope that you'll consider joining. We have a huge member network that's growing every day. I think we're one of the largest clubs now, if not the largest in terms of active members. And we have a variety of things coming up. As you can see on the screen, a really fun event coming up October 10th, Changing the Relationship with Your Wardrobe. That'll have a lot of specific things and examples, which will be a lot of fun. And then there's other things coming up. Some are in New York, but the other one's Global Networking Night. That is where we encourage you to go to whatever the event your local club is having, but we will also be hosting something at noontime on that day on October 22nd. And there's another event on AI on October 29th, AI or Hype, Distinguishing Game-Changing Tools. And then October 30th, Own Your Worth, Tradition, Trust, and Time. So that is another financially oriented one. And we've got others in the queue, ranging from longevity to some more financial items. So stay tuned, read your newsletter. And of course, we have great roundtables that we have on a monthly basis. So thanks for that, Alexi. So welcome, everybody. We're excited to have this. I think it's such an interesting topic because, you know, the process of selecting a financial advisor or deciding whether or not you need one is not an easy one. And we found out about this great group through the Charlotte Club because I think they did an event, a presentation there. So I'm going to introduce Lauren Simpson, who's the VP of Growth Marketing for 360, right?
Yep.
And 360 Rebalance. And Lauren will introduce Mitch and Christie. And Mitch is also an HBS grad. So we have that in common. Anyway, welcome, and go ahead, take it away, Lauren.
Well, thank you so much, Deborah. I appreciate it. We're really excited to be here with you all today. Let me go ahead and share my screen and bring up our presentation. And then the other thing, while I'm just kind of talking through these first few slides, I'm going to put up a poll too. And this poll has two questions. The first is, what financial topic do you feel the least confident about? And there's some options in there: investing, retirement planning, taxes, estate planning, and then budgeting and saving. And the second question is, what age group do you fall into? And I'm going to let you guys answer that as I go through the intro slides, and it's just going to help Mitch and Christie during their presentation better inform what you all are hoping to get out of this presentation today. So this is a webinar. It's part of our Women in Wealth series. This one is titled Avoiding 5 Costly Mistakes When Hiring a Financial Advisor. We've identified that there are really 5 areas where people do tend to make mistakes when they're looking to hire a financial advisor. And so after watching this, hopefully you'll be better informed to avoid those pitfalls. And so at Rebalance, we recognize that women, they often oh, sorry, what was that? Okay, there's just an echo there. They often face unique financial challenges, things that longer life expectancies, potential career breaks, balancing caregiving responsibilities. So the financial journey for women often looks different from that of men. And that's why we created the Women's Wealth Series, a dedicated program designed to addressing the specific financial planning needs as women. And we're excited to be at this event with such a great group of women. I'll go ahead and introduce our speakers. So the first speaker, Mitch Tuchman, as Deborah said, he graduated from Harvard. He graduated in '82, Section B. So if anyone here recognizes him, his career has spanned the technology and investing industries, overlapping in recent decades. And a common thread throughout his career has been his mission to find solutions that will help consumers. In 2012, Mitch partnered with his colleague Scott Puritz, also a fellow Harvard Business School alum, to develop an innovative investment offering for consumers that was completely unique from the commission-based brokerage model that was prevalent within the financial services industry. And they founded this firm, Rebalance, to help Americans plan for successful retirement. The firm offers endowment-style Ivy League investing, top-notch service, transparency, and some of the lowest fees in the industry. Mitch is also a frequent guest on CNBC, PBS Wealth Track with Consuela Mack, and CNN, and he's frequently featured in major financial publications, including the New York Times and the Wall Street Journal. So welcome, Mitch.
Thank you.
And also with us today, we have Christie Whitney. So Christie is one of the exceptional financial advisors at our firm, where she serves as the Vice President of Investment Advice and as the Director of Financial Planning. She leads our firm's financial planning team with passion and experience, ensuring that our clients are positioned for long-term success. Christie is a certified financial planner, a CFP, with over 25 years of experience in the financial industry, a field that remains predominantly male. In fact, only 20% of financial advisors are women, and Christie is one of the outstanding professionals breaking that mold. Her leadership and deep commitment to her clients makes her an invaluable part of our team and an inspiring figure in this space. A proud alumni of UC San Diego, Christie also holds a graduate certificate in personal finance planning from UC Berkeley. With her extensive experience and dedication to empowering others financially, Christie is here to share her wealth of knowledge with us today. And now that you know a little bit about the speakers, I'm going to tell you briefly just a little bit about our firm, Rebalance. So Rebalance has over $1 billion of client investments, or AUM, and we are a holistic wealth management firm. We're proud to call ourselves consumer advocates, and I can almost guarantee that you won't find a firm more passionate about helping investors. In fact, our managing director has even testified before Congress on the subject. It's one of the cornerstone principles of our business. We have comprised our investment committee with some of the brightest names in the investing industry, people who we know have led the charge on pro-consumer initiatives and have the experience and knowledge that our clients deserve. These members include individuals who pioneered index investing, including Charlie Ellis, Burt Malkiel, and Jay Vivian. And this is the last slide before I turn it over to the speakers. So this is kind of just a slide to brag. We're proud to have been recognized for our commitment to excellence and client success. Rebalance has earned several prestigious awards, including Best in State Wealth Advisory Firm by Forbes, Best Financial Advisory Firm by USA Today, and more. These accolades reflect the dedication of our team to delivering top-tier financial guidance and personalized wealth management service. So with that, I will turn it over to our speakers and Christie.
Thank you so much, Lauren, and thank you all for attending today. I'm very excited to speak to the specific audience. Our theme today is 5 costly mistakes to avoid. So first one is not having a comprehensive financial plan. The second being unclear on the fees that you're exposed to and paying in your investments. The third, responding to emotional triggers during your investment journey. Fourth, using an advisor who does not understand your goals. And fifth, focusing on short-term returns versus the long term.
And Christie, actually, before you jump into the first one, I forgot to end the poll. So I'm going to end it now and share back the results with everyone. It looks like the majority of participants selected investing and growing wealth as the topic that they're least confident about, with the second one being retirement planning and then estate planning as a close third. And the age range for the women in attendance today, it looks like the bracket of 40 to 59 is the most common.
Got it.
Okay. All right.
Great. Thank you so much. So let's go over mistake number one, not having a comprehensive financial plan. So many of you may have investments out there that are scattered amongst, old 401ks or IRAs or other investments and cash, but no holistic approach to your whole plan. So we found that having a plan really serves as a guiding light for folks throughout whatever stage of life they may be in currently and then looking forward. First, I think it's important to talk about how the advice industry has changed over the last several decades. So, over here on the left, we have, the traditional investment models that began several decades ago with having the big brokerage firms and investment banks. Like Merrill Lynch, Morgan Stanley, UBS, where you have an advisor buying individual stocks, individual bonds for you and your family. And then that gave rise to independent brokers, kind of branching off those big firm models, such as Raymond James, LPL, Ameriprise. In the late 90s, with the rise of the internet, we experienced a whole huge revolution. And that's actually when I started my career, which was pretty exciting. But, went to decimalization, fast trading in the marketplace, everything became electronic. And with that, we saw E-Trade, Schwab, Fidelity really rise to the forefront. And people began to trade themselves. Discount brokers rattled the model of, these old brokerage firms charging $300, $400, $500 per trade. So a big upset in the industry, and we continue to evolve from there. These days, many folks are looking to the investment advisory model, which is more of a overall picture for you. Some of the firms listed here, the big ones you've probably heard of, Edelman, Fisher, nationwide firms. And this model is more of a fee for service. So you're being charged on the assets that are being managed and away from that commission model. Also, with a registered investment advisor, we're held to a higher standard of care than the big brokerage firms. So that's the fiduciary standard, and really putting your client's interest in front of your own at all times. And then from there, we include ourselves in this category. We are very tech-driven advisors. We utilize technology heavily at Rebalance. And because of that, we are able to charge way less in fees for our clients. So down at the bottom there, you have a graph just showing how fees have also changed over the years. I'll say that, very traditional registered investment advisors are still charging 1 to 1.5%. It's only these models like ourselves and maybe Vanguard and Wealthfront that are charging less because it is all primarily a virtual experience. So when you're looking for an advisor, there's all kinds of different people out there that are going to approach you and tell you this is what you need. And on the left here, we kind of have a collection of things that actually don't matter in your process. So while a CFA is a highly esteemed designation, it's more research specific on individual companies. The Series 7, the stockbroker licensed life insurance, those are all very singular designations. And so really what you want to look for is somebody who is going to partner with you, who's studied all the different areas of finance, which would be a certified financial planner, and then really drilling into the appropriate investment mix, also referred to as your asset allocation for you specifically. So not, some model out there or some designated type of account, but really what is important to you and your goals. And then someone who's paying attention to, the behavioral aspects of investing and helping you stay disciplined and calm. and really having a relationship together, where you also will talk about things like tax planning and estate planning for your legacy. So as Lauren mentioned, us women have additional challenges, if you will, on our financial journey. And here's just some of interesting stats, but also things that become challenges. So more and more women are out there doing things alone, and are educated. We have, single women own more homes than males. Our percentage of women earning bachelor's degrees or higher has increased dramatically over the years. But some of the challenges that have been present for many years continue, right? So if you do have a family, you're likely to experience a period of time where you had to either exit the workforce or take less demanding or part-time work and to care for the kids, right? And that has a ripple effect. Um, Not only are you then earning less, but then the percentage that you're able to save towards retirement is less. And also that ripples into your Social Security benefit. So women typically do receive less in Social Security, and also the pay gap plays into that. I mean, it's incredibly frustrating that many industries are still not paying women the same as men, but that is a reality we're still fighting against. Another important thing to realize is you're more likely to be a caregiver to a spouse or parent. 75% of caregivers are women. So that may also affect your retirement time horizon or your ability to work, more midlife, late stage in your career. And we live longer. So women tend to live 5 years longer on average than men. So our time horizon is that much longer. And that's why it's really important that we have a plan and are able to see, how our money is projected to flow over the years. So when you have a financial plan, you're able to, look at things, not only the investment piece, but what matters most to you and your household. So getting your arms around all the accounts and investments, like I talked about, talking about, what is a good amount to have in an emergency fund? What should I have in risk-free assets like cash? When should I claim Social Security? If I'm offered a lump sum pension, do I take that as a lump and roll it over, or do I take it as an annuity? All of these different things listed here are things that we touch on and cover when we're building a financial plan. Here's just a snapshot of a piece of a financial plan. There's a couple things I want to mention on this slide. One being that there are financial planning models that you can access online. However, I've tested a lot of them and I feel like the majority of them have gaps, and then that can lead to misinformation. So I think it's really important that you have a seasoned professional building a plan, talking with you about the results of the plan, and interpreting the data. Because as you can imagine, it's easy to misinterpret all these numbers. So this is a cash flow report, and on the left, you see this individual, is retiring in a few years. The blue bar charts represent their assets, and their assets just continue to build over time. So the financial plan is looking at your income, your expenses, the assets that you have, the return expected on those assets, and then what may happen over the next couple decades. The individual on the right here looks like they're going to get into trouble later in life. So they're, I would guess here that they either haven't built up enough or they're just spending a lot over the years. So these are the things that obviously we look at. If we see a chart like you see on the right, then we've got some significant work to do, right, with our clients. So just planning out this whole long trajectory and recognizing that you have a partner through the years to readdress issues is incredibly important.
Okay, I guess I'm going to take it away from here. And nice to see everybody here or meet everyone here. I'm going to cover the second mistake. We at our firm have dealt with literally, I don't know, maybe several thousand people over the years and talked to them about fees. And I would say that very few really understand what they're paying for investment advice. And understanding fees is a really key part of knowing how your money's working for you, because fees are like a hidden tax. So let me dig into fees a little bit. Um, the idea about fees is if you look at what you can make in investing your money in the stock market and bond markets over a long period of time, those numbers are fairly predictable. We're going to cover that a little bit later. Even if you look at the largest endowments and foundations in the world right now, they will target something in the high sixes and low sevens. And these are the most professional investors in the world who have access to the best investors in the world. So let's just take six on the low end. If you're paying 2% in fees, and 2%, you may not even see a lot of it because it's buried in the funds that some advisor has purchased for you, or there's back end fees being paid, particularly at the brokerage firms. And we've seen everything. It means that only a third of your return is coming to you. So this is not like how much do you tip the wait person? Do you give them a 15 or 20% tip? This is a percentage of your investment profits that goes to someone who's selling you advice every year. And over time, that amount creates a dramatic dent in your portfolio return. So on the next slide, this is a study about certain firms and all the fees they're charging. And there's really two types of fees. One is what the firm charges you for advice, like our firm charges a fee for advice, but then also there's the fee for what funds they're buying for you. So if you have a firm like one of these brokerage firms, this was a study done, when they put you into funds, those funds have fees as well. And if there are funds that are called actively managed funds that are working on short-term profits for you, the fees get very high. So here's a study that was done on the total all-in fees. One thing you'll notice is the commissions are no longer part of most brokerage firms because those were eradicated, but there are also fees built into wrap accounts and things like that. But again, look at these fees. If you're talking about something, over 1%, that's just something that's getting slowly siphoning out of your account every year. I wanted to just show you the next slide because earlier Christie mentioned that firms like ours who are fiduciaries, this is sort of an industry range of where they are, the bands. And I just wanted to put ours in here in context because one of the things we're very proud of, and there's other firms that do this as well, but you want a firm who's working very hard to drive down their operating expenses so that the fees you end up paying are below 1%. One way we do this, by the way, in the next slide, is we use what we call index funds. And I'm sure many of you are aware of what an index fund is. The other term of the fund is passive, but there are really two types of funds. One is where you have people working at the fund trying to pick the lowest cost, or not the lowest cost, working to beat the market. So for example, a large cap manager at Fidelity is trying to outperform the S&P 500 by selecting the 30 to 100 stocks that manager has researched and thinks are going to do better than the S&P. Most of the people we've encountered have no idea who's managing which funds. Are they these sort of actively managed funds, which are very expensive, or are they more passively managed funds like the concept that Vanguard introduced years ago, where instead of trying to pick stocks within a group of stocks that will outperform that group, you simply buy the whole group through something called a passively managed fund. They're much less expensive, and all the data shows you'll end up doing better. And we'll talk about that more. But to put a finer point on it, this is what Warren Buffett has said he would put all of his non-Berkshire stock into, and what he's recommending for his heirs and beneficiaries of his fortune. So there's a lot of data that shows this, and if you want to talk to us more about this, we can send you in places that will empirically prove what I just said is correct about using index funds, and also about figuring out what your fees are, which we've done for many people over the years. And people are astounded at the hidden fees that are buried in their portfolios, particularly from the large brokerage firms. And now I'm going to pass it back to you, Christie, to talk about mistake number 3.
Okay, great. Thanks, Mitch. So mistake number 3 is responding to emotional triggers. We're all human beings and have our emotions, and time and time again, studies have shown that those that work with a trusted advisor make better financial decisions. And part of that is when you're going through these volatile periods in the market. So behavioral finance is a big piece of what we address and what we do. At the top here, we have a fun little cartoon about, a saber-toothed tiger. And really, it's in our DNA to react when there's a problem. And we have physical, reactions to that. There's just, your heart pounds, your mouth's dry. And these are some of the emotions that we can feel when we go through volatile times in the market. And we really have to take a minute and calm down, and having someone to talk to and having some, maybe empirical data on your side can really help with that, because panic is not an investment strategy. So this slide is going through a unique period of time that we all live through. 2 years before COVID and 3 years after. And, COVID hit overnight, essentially, and the markets reacted steeply downward very fast. And it was scary on a multitude of levels. This chart looks at, what if you exited the market at the bottom in March of 2020 and didn't return until a later date, several months later. So the folks that stayed invested in a 60% stock, 40% bond portfolio kept a return of 21%. But the folks that exited the market ended up negative for this time period. So as hard as it is to recognize and to see our money decrease during periods of time, that is part of investing, and we have to keep calm during those times. The next slide shows the benefits of staying invested through these volatile periods. So what we're looking at here is essentially a 20-year period of time with $10,000 invested in the S&P 500. So folks that stayed invested during that time, and remember, 08's in here, and the major financial crisis is in here. Staying fully invested, that 10,000 turned into close to 65,000. If you miss just the 10 best days in the market, you have less than half that amount. And it just continues to decrease over time. So of course, there was scary periods in here. But the interesting thing about the markets is some of the steepest down days are followed by the sharpest upticks. So if you're not there for the negative days, you're not there for the positive days. We'd all like to avoid the negative days in the market, but cherry picking that just is not successful. So I think this slide is really telling here. Oh, I guess that was the end of that mistake. So, I mean, again, just driving the point home that if you have someone to talk to, we call it talking folks off the ledge. It inevitably happens with, a handful to a dozen clients when there's a major event in the markets, and we're there for them. So, I'll let it go back to Mitch here.
Yeah, thanks, Christie. And this is sort of part of that. Mistake number 4. If you do not have an advisor that you're working with who really gets you and what your goals are and how you react to situations like COVID, how you react to good markets like we're in right now, that advisor is really not doing their job. Your money should reflect your values and your life goals. And let me be a little more specific. We view, and I think great advisors view, the relationship with a client as a partnership. And that partnership means that we understand where you are in your life cycle. We want to help empower you to achieve depending on where you are. If you're still working or if you're about to retire, our advisor, a good advisor, acts as a guide who can collaborate and understand. And there's really never one size that fits all. all of this informs the way your money should be invested. So an advisor really gets you, can help you make basically this fundamental decision. I mean, we can make this more complicated than it is, or we can look at the fact that there are stocks where you are an owner in a company. Whenever you own a stock, you own a piece of a business. And there are bonds where you are not an owner, but rather a lender to a company or a government. And the bonds, mean that you have a coupon and you get paid interest, and you should be paid back your bond when it matures, as long as it's a safer bond. Stocks historically will go up and down. The S&P 500, one year was up almost 53%, and one year was down almost 37%. But over the long term, over rolling average periods of 5, 10, 20 years, annualized returns pretty good for stocks. But for bonds, while the best return is up 14% and the worst is still making you a little bit of money, you make half as much. And that's just the fact. So the investment experiences with stocks, it's sort of no pain, no gain. You'll make a lot more money, but you will have a roller coaster ride. That simple fact informs the way we as advisors, and a good advisor will help a client figure out the investment mix. So on the next slide, you'll see when you mix it up a little differently, and the little orange dots sort of show different annualized rates of return, you will see that there's wider dispersion in a given year of how much your portfolio could vacillate, but you'll make more money. And there's these mixes, and again, it's a lot more sophisticated than just stocks and bonds, because within stocks and within bonds, there are different types. We and other great advisors try to put the right mix together. So on the next slide, if you get a little more granular on this, you'll see various mixtures. And this is where the personalization occurs, the importance of life stage planning and family milestones. So for example, if you're into your 60s and you've maybe put a bunch of money in a Roth IRA, but you realize that Roth IRA you'll never use, it's going to be inherited by your children or grandchildren, that may be managed in a much more aggressive way than something that you're relying on for paying your living expenses in retirement. Or maybe you're hitting your peak earning years during your career, and while you don't like market volatility, this is a better time for you to go heavily into the stock market as you add money to a portfolio, because you continue earning and saving, and helping you understand all of that stuff and where you might hit a bump in the road. A lot of people get in this interesting stage where they are turning into their early 60s, retiring, but there's a 10-year period before they can take Social Security or distribute their retirement accounts. All of this goes into being a good partner. So we have a committee of some of the leading experts in the field. These are not Wall Street people. These are fiduciaries. We have Charlie Ellis on the left, who ran as a head trustee at Yale, the investment committee. Burt Malkiel, the first three gentlemen are HBS grads, by the way, but these are sort of legends in the industry. Jay Vivian in the middle with the red tie. He ran the IBM retirement fund. Christy Craig manages the National Geographic Endowment, several $1 billion. And we in our investment committee meet regularly and talk about mix and cohorts, clients, what sort of information we need to understand to better put the mix together. Then I'll pass it back over to you for our final and fifth, Christy.
Okay, great. So our last mistake we're going to talk about today is focusing on short-term returns and not the long term. It's really not about, what did your portfolio do last year, or what did this singular investment earn you, but it's about building security, right? And laying the groundwork. So I'm sure a fair amount of you may recognize this gentleman. This is Jim Cramer, and he is the host of Mad Money on CNBC every day. He's been on for many years, and he's got all his tools and gadgets, and he's trying to, talk about trading, essentially. This guy is an entertainer, and he's talking about let's beat the market. Well, to beat the market repetitively is not possible, and you simply need to own the market in the right way. Similarly, we'll hear hype over time about a specific mutual fund that's a darling of that year, or here's Kathy Wood with her ARC fund, which did phenomenal for a while. But most times, your average investor enters a fund like this after hearing the hype, after the run up. Then the fund tends to have huge outflows. And, her fund, for example, after its peak in 2021, fell 75%. So, who's left holding the bag, selling at the wrong time? Most often, it's your average investor. And that's a huge danger. This is just another example of, all of these quote unquote experts trying to make forecasts or predictions about what the market's going to do. And that all is just that. So you've got, Goldman Sachs on here, JP Morgan, Morgan Stanley, UBS, and here's, 2023, their forecast for where the S&P 500 would end. Their average forecast was in the 4,000 range. The S&P 500's actual closing was over 4,700. So no one can predict this stuff despite what they might say and the hype that they try to build. Here's another one, the idea that you own a mutual fund, which is run by two very smart individuals typically, and they're trying to pick the winning stocks to be in this fund specific to fit the objective. But the reality is that these funds underperform their benchmarks consistently. So we have a string of different time periods here, and you see this is the percentage of time, let's say 10 years, for example, that these actively managed mutual funds underperform. So the idea that you can own an index fund, essentially owning a benchmark, and do better and pay less is what we're trying to drive home here. You simply need to own the global marketplace in an intelligent way. There are other things to think about with short-term trading. There are huge tax considerations if we're talking about, an investment account that's outside of retirement accounts. So this kind of speaks to an older model, but people that trade stocks actively, they maybe set a price target, and then once that target's achieved, they sell, and they consider that success. But your selling is reducing your gains significantly. So true wealth creation is built by holding appreciated assets and owning these tax efficient funds where there's not a lot of turnover, generating capital gains and generating tax. I think this slide is really powerful. What we're looking at here is, again, a 1, 5, 10, 20-year time period. And the kind of pumpkin color there, you see a whole range of returns that are possible for stocks. In green are bonds, and in blue is a blended portfolio. So let's look at the 5-year rolling period and that blue bar chart. And you see that there was not a single time period here that was negative in just 5 years. And you go further out and you see, a higher degree of success, and you're away from that negativity. So holding for the long term and having a portfolio design that you can stay in for the long term is really important. So that 60-40 portfolio over this 70 plus year period averaged 9.3%. And the growth was, really phenomenal there. So one of the things, this is what I wanted to mention here, was one of the things I see working with women is we tend to be more conservative, and that's a big danger. Mitch is going to talk about that a little bit more with inflation and whatnot, but we don't want to have too much in assets that are not growing. And we have to accept the reality that equity is the our chance at the greatest returns. So having an equity component in your portfolio should really be present to different degrees on your whole path. People tend to want to shy away from owning equity or owning as much equity as they age, but retirement is a couple decades long for most people these days. So it's really important that we have that growth component in our portfolios.
Yeah, I'm going to add something in here, Christie.
Mhm.
There's a word that's thrown around a lot called risk, the word risk. Oh, I want to be conservative, like yeah, it's very good to be conservative as opposed to be, risk seeking. We're not talking about buying cryptocurrencies here. We're not talking about hedge funds. We're talking about publicly traded stocks on a global basis that have done nothing over decades but continue to appreciate. And so there's a difference between putting money into an investment that you may never see again versus putting money in an investment that will grow in a very predictable way but have volatility along the way. So we look at volatility as distinct from risk. If you can live with volatility, like Christie was talking about, you can live with volatility. That's different than saying I'm conservative. In a way, the paradox is to be conservative, it means to live with some volatility so that you can achieve in a conservative way, meaning with a lot of room for error, your financial goals. And this is the kind of conversations that your advisor should be talking to you about and should understand the data and the perspective to allow you to make better decisions. Back to you.
Oh, thanks. So these are just some long-term investing priorities. Like Mitch mentioned, there's different definitions of risk. Another angle to take with risk is also thinking about, protecting what you've built, right? And so we talk to clients about insurance and any kind of hidden dangers out there with their financial picture. We want to think about your family and your financial security, and the biggest thing is maintaining independence, right? Are you going to be able to live the way you want to live? And the focus has to be on the long term, and not just what are the markets doing for me right now, but having that focus. The last thing is, having flexibility and adaptability. Your life's going to change. Maybe one bucket of money is going to work for you differently than another bucket of money because its time horizon is different. So it's important to address things in that manner.
So I'm going to take it from here and wrap this up, and then we're going to go to questions. But why does all this matter? Why does all this matter? Well, when we started this firm, we learned about this. It's from a firm called Dalbar, and they look at literally tens of thousands of brokerage accounts, calculate what the average investor achieves versus what a very a regular 60-40 portfolio. And every year they come out with a new updated study. We call this the investor gap, meaning that people out there, regular investors, if they just did something ridiculously simple, would make a lot more money than they do trying to make something that should be very simple, very difficult. Wall Street loves to push all this activity on people, but it really gets in your way. If you just look at this 5.6% difference and what that means, it all gets down to why it all matters is what you're compounding your money at. If you went to HBS, you probably took a class and understood the power of compounding, meaning how your money grows, and when you make a return in one year, how that return gets added to the return of the next year. So, Lauren, let's go to the next slide. This 5.6% return, the difference between 2.5% and 8.1% over a 20-year period is more than double. Over a 30-year period is like 4x. Okay. There's a rule of 72, meaning if you divide the rate of return that you think your money can grow into 72, that will define how many years it takes for your money to double. So if you look at a reasonable rate of return with say, 80% stock portfolio, 20% bond portfolio, growing at about 7.2% on an average basis, every 10 years your money's going to double, which in this case takes $100,000, and it just doubles it every 10 years. Some of us don't have a 40-year time horizon, but many of us have a 20-year time horizon, maybe a 30-year time horizon. If you're looking out, the most important thing and why all this matters is the compounding rate. How much is your money growing and compounding on an annualized basis? On the next slide, this is a little bit of a table showing, 10 years, 15 years, 20 years, 25 years, and the first column on the left, and different compounding rates, 2, 4, 6, 7, okay? So you look at the difference between a 4% and a 7% compounding rate over a 25-year career, you have twice as much money at 7% versus 4%. We've talked about fees. If you're paying an extra 1% in fees that you shouldn't be paying, that's a big deal when you're looking at a spread between 4 and 7%. If you have an active manager that's trading the hell out of your account and you're giving money up because you're paying taxes, that could also reduce your returns by 0.5%. If you're dealing with advisors who are trying to outguess the market and they make mistakes because the markets beat them, it could be another 1%. This is why it all matters, is the compounding rate. And the other, dirty underbelly of all this on the other side is the inflation rate, because inflation is the reverse. It also erodes your money. So a 3% inflation rate means that if today, you're looking at a $40 steak dinner, in 15 years, it's going to be $64. The inflation rate means that your dollar today doesn't buy what your dollar will buy in 15 or 20 years. So why it all matters is that you've got to be compounding. It's like a little bit of a race. You've got to be compounding at a rate that's greater than inflation, and that in addition to that will give you enough money to pay the bills when one day you're not working and able to get a stream of cash flow. So at the end of the day, I then defer to Albert Einstein, who did say that compounding interest is the eighth wonder of the world. In your case, she who understands it earns it, and she who does not pay it doesn't pays it. This is really the key. So in sum, and now we're going to go to some questions, just want to review the 5 key things. You really do need to have a great comprehensive financial plan done by somebody who knows what they're doing, not an H&R block of financial plans, but a super talented CFP who understands how to build these plans, interpret the data, and use it as a platform to work together over the years on a long-term plan. You need to understand what your fees are. We can always help you analyze your fees if you want to reach out to us. Someone who can help you with things that trigger you emotionally that may take you off your strategy and off your long-term commitments. And also an advisor who knows how to understand your goals, build the mix for you, and also keep a focus on long-term. It works. The data proves it. Short-term, it doesn't prove it as much. So there you have it. I think I'm going to hand this over for questions.
Well, thank you so much, Christie and Mitch. And I have gotten a few questions. So anybody who is thinking of something right now, I'm going to go ahead and start with the ones I've gotten so far, but you can throw a question in the chat. If you feel like maybe it's a dumb question, you don't want everyone to know it was you, you can send a direct message to me and I won't say your name when I read the question. So the first question I will go ahead and field. Someone asked if you guys are going to get a copy of the PowerPoint slides. And the answer is yes, we're going to get it over to Deborah and she's going to make sure that it gets to you. So you will get these PowerPoint slides. If there was a chart or a graph that you want more time with, you'll be able to take a look at it. Or if you want to share it with somebody who wasn't able to make it today, you can do that as well. So one question that I got at the beginning, Christie, when you were categorizing the evolution of this field was, how would you classify a firm like Betterment?
I can maybe take that.
Okay.
When we launched our firm, there were also some venture-backed firms that were launched. Betterment was one of them. Wealthfront was one of them. We were actually involved in launching they're called robo-advisors, meaning there's nobody on the phone to talk to. You do this all online, you fund an account, and you answer a few questions with some sliders or whatever, and they come up with an asset allocation for that account, and it's invested that way. It's 0.25%. For young kids, it's great. You get a great investment allocation. It's rebalanced. It's low cost. Everything we've been talking about. I was personally involved in starting one of those many, many years ago, and investors just kept calling and wanting help. So Rebalance came from a robo-investing background, but we added the advisory piece to really be a full-fledged wealth management firm that gives you the best of both worlds. The robo-investing methodology, which really does work and is at the heart and soul of how we invest, but with a wealth management level of expertise, financial planning. And that's the basic difference. But for younger people with less money, smaller balances, a robo investment firm is a great approach. Another alternative to robo investing are things called the Vanguard Life Strategy Funds. They're effectively the same thing, and they're even less than a robo investment firm. One that's like an 80-20 portfolio in Vanguard is VASGX. Do the same thing. Next question.
All right, this next question is, I think it came out during the slide about what does matter, what doesn't matter when you're searching for a financial advisor. They asked, is there any sort of certification around Medicare expertise?
That's a good one. Not that I am aware of. Mitch, are you?
No, but I would say that a lot of people, unfortunately, in financial services, there's a lot of designations. People can take quick courses and get a lot of letters after their names. This is not like medicine where, you know, if you hire an MD, you know what they did to get that title. But I will tell you, look up CFP, Certified Financial Planner. Look at what's required to get a CFP. It's rigorous. It's many years. And included in that is Medicare and all of the various types of analysis, like the question asked. It's not a designation, but it's part of the CFP training. In addition, how to make Social Security decisions, how to make all kinds of decisions are involved in the CFP designation. It's a very special, very rigorous training, and includes probably a lot of things that you might ask about.
And Mitch, I got a follow-up question to when you were talking about Betterment and the different levels and where it makes sense to go with, if you have a smaller balance. They asked if Rebalance has a minimum amount for investing.
Yes, we have a minimum of $500,000, but we are a wealth management firm. It includes financial planning and a lot of expertise. So if you don't need all of that, particularly if you're younger or don't have as much money, we probably aren't for you, but I would definitely recommend Betterment or Wealthfront, or even some of the robo services offered by Schwab or Fidelity. Many of them are great, but just check the fees.
Great. Pam asked, does a firm like Rebalance offer FDIC coverage on any of the investments or cash?
I can take that. So we're a registered investment advisor. So we do not actually hold our clients' money. That money is held at Charles Schwab or Fidelity for our clients. So that's where it's called custodied. So investment accounts have what's called SIPC coverage. So that's the security protection, different than the bank's FDIC insurance. So if, the world were to go to heck and something happens to the firms like Charles Schwab and Fidelity, who hold trillions and trillions of dollars, which is highly unlikely, but there is protection there for investors underneath that SIPC umbrella.
Great. And we probably have time for one or two more questions. And then I have a couple of slides for if anyone needs to get in contact with us or has questions as a follow-up to this event. So one question, Christie, this is probably a good one for you as a financial planner, is I have an old 401k. Should I roll it out or keep it with the firm that it's at now?
Sure. Typically, it depends on the size of your company, but there's compelling reasons to roll a 401k to an IRA. Certainly, lots of times it is related to fees. If you're at a small company 401k, there's layers and layers of fees with 401ks, and only the very, very large ones have fees on the lower end. With an IRA, you can invest in anything, not just the investment selection that you're given with the 401k. And then the other thing is it's the reality is for a lot of people is there's several job changes throughout your career. So you may leave a company 4 times. And if you have, we call them stranded 401ks out there, you don't know what your overall allocation is. And more often than not, when we see folks with different accounts in different places, their risk is higher than they had any idea about. So I would encourage rolling to an IRA and having professional management on that if you're open to it. The other option is you can have that 401k move to your current company 401k. So that is another option. But again, I would pay attention to fees there.
And the other problem we see all the time is when you started a job, you had a list of investment options and you picked maybe a target date fund and a large cap or whatever you were thinking at the moment and forgot about it. And then, 2 or 3 jobs later, you've got this whole yard sale of different investments and different 401ks. And again, there's no holistic thought and strategy behind how your money's invested. Sometimes they grow quite large.
All right. And then the last question that I think we have time for is, to what extent does the financial plan help you with an estate plan?
So we're not estate lawyers. So, it serves as a guide. We can talk about things like gifting strategies, charitable donations, the best ways to make charitable donations, helping you think about your heirs and how you want things to flow. But you need an estate attorney to draft that trust for you, to do all the legal documentation. So it is, again, another layer of a partnership. And at our firm, we're open to having joint meetings with clients, professionals like CPAs and estate attorneys, to help sometimes a client communicate with that professional and make sure everyone's on the same page.
Let me just give an example of that. We've had clients, Christie, you have, I know, where they had no idea how much how much money they would start compounding later in life. And they look at their kids struggling and needing help on a house, and they've wondered, can I give them a down payment? How's that going to impact things? And as Christie mentioned, by doing a financial plan, you might realize, well, geez, I can easily help them with a down payment and no impact to me on any chance of running out of money when I'm 80 or 90 in the worst situation, because a lot of our planning is to stress test the plan. So in terms of kids, it's very useful to do a financial plan to inform your thinking about how you want to handle your estate, and not be fear driven. And I will say to this, a lot of our clients have saved a lot of money because they're very risk averse and they like saving and they like putting it away. But as you shift into a different frame of mind in life, you have to get a little more used to letting some of it go. And that's a very tough thing to do for a lot of people. So financial planning sure helps run the numbers.
Yes, it provides a huge sense of peace, overwhelmingly, is what we see for people. So
Well, I appreciate, Mitch and Christie, your responses. I also appreciate those who sent me questions. There were a couple we didn't get to, and one that was very specific that I think would be better if you were to just email us. So I'm going to get to a slide with my contact information. But I'm also going to put in the chat. So we've got this link where you could schedule time with us and ask us questions. We could talk about your individual situation. These are the kind of questions that we get the most frequently. Mitch mentioned a free fee audit. If you want to set up time with us, we can take a look at your current investment advisor. We could tell you what you're paying. We know kind of where they hide it in those statements for some of these hidden fees. So getting an idea of the all-in fees that you're paying right now, we're willing to do that for you. If you have a question about if you have the right asset allocation, that slide where we showed the different mixes, maybe you're not sure if you're invested appropriately for your age, or you're not sure if you're invested appropriately for the buckets of money where you have it set aside for different purposes. These questions are things that we can answer for you. So if you would like to schedule time with us, that link that I put in the chat works, or you could scan this QR code. QR codes made a big comeback during COVID. And the other thing that we're offering is, because you guys all came here through the HBS Women's Association, if you sign up to speak with us through that specific link, then you get a copy of the Elements of Investing. It was written by a member of our investment committee, Charlie Ellis. Some of you may have read it back in an economics course when you were in college at Harvard, but this is just a really small guidebook. It's really great. It has some basic principles of investing. It's the kind of thing that you can read in a couple of days and then pass it along. I ended up doing that to my dad. I passed it along to him and he found it helpful too. So if you'd like a copy of this book, we'd be happy to mail it to you. You just have to schedule time using the link or this QR code on the slide. And then finally, if you have a question, you're not ready to schedule time with us or book a meeting, but maybe you just want to email me your question, I can make sure it gets to the right person. If Mitch or Christie are better equipped to answer it, or someone else within our firm, you can send me an email. That's my email, Lauren L. Simpson at rebalance360.com, and I'll just make sure it gets answered and that it gets to the right person. So that is our last slide. Thank you so much, Deborah, for having us.
Thank you.
Oh, you're muted.
Thank you. It was certainly an interesting presentation, and I think very valuable for many people who attended. So again, thank you. And we look forward to all of the people who may want to follow up with you. So take care.
Thank you so
Thanks,
much.
Deborah.
Have a great day, everyone.
Bye-bye.